In this scenario, our conversation will revolve around the world of investing in stocks. You know how you buy a stock when you own a small piece of that company? Well, it's kind of like buying a tiny chunk of your favorite restaurant or toy store. When you invest in those companies, you're essentially betting on their success and hoping to make money from it. Think of the stock market as a big game of chess. Just like how you need to think several moves ahead to win the game, investors need to do the same when they buy stocks. They have to consider all the factors that could affect the company's performance before making a decision. Imagine you own 10% of Apple. You've invested $1,000 in a single share of Apple stock. If the company does well and its stock price increases by 20%, your investment will grow to $2,000. But what if the company suddenly faces financial difficulties? The value of your investment might decrease significantly. This is where diversification comes into play. Just like how you wouldn't put all your eggs in one basket, investors should spread their investments across different sectors and companies to minimize risk. It's like having multiple types of candy in a bowl. If one type gets stale, the others will still be sweet. Now, let's talk about the different types of stocks. There are two main categories, blue chips and growth stocks. Blue chips are considered stable and reliable, just like a favorite TV show or movie. They have a long history of success and tend to perform well over time. Growth stocks, on the other hand, are more volatile, but they have the potential for huge returns if the company grows rapidly. Think of it like a sports car. Blue chips are like a reliable old sedan that's been around for years. They're not going anywhere anytime soon, and you can rely on them to perform well. Growth stocks, however, are like a brand new sports car. They're fast, flashy, but also high risk. Another important factor to consider is the company's financial health. Just as how you wouldn't invest in a company that's facing bankruptcy or has poor credit ratings, investors should be cautious of companies with weak financials. It's like buying a house on the cheap. It might seem great initially, but eventually, you'll realize it's not worth what you paid. Now, let's talk about some popular investment strategies. One common strategy is called dollar cost averaging. This means investing a fixed amount of money at regular intervals, regardless of the market's performance. It's like buying a basket of fruits. You wouldn't buy all the apples at once and then suddenly decide to only buy a few every week. You'd rather spread your investment across time. Another strategy is called value investing. This means looking for undervalued companies that have strong fundamentals but are priced low. It's like finding a hidden gem in a treasure chest. You wouldn't buy the chest if it was already filled with gold coins, but instead, you'd focus on finding the most valuable treasure within. And then there's the world of ETFs and index funds. These are like buying a slice of a pizza. They offer a diversified portfolio of stocks or bonds at a relatively low cost. They're a great way to get exposure to various asset classes without having to pick individual stocks. Now, let's talk about some common mistakes investors make when investing in stocks. One mistake is being too aggressive. You might buy a lot of high-growth stocks with the idea that they'll skyrocket, but if the market turns sour, you could end up losing money quickly. Another mistake is overtrading. This means constantly buying and selling stocks based on short-term market fluctuations. It's like trying to catch a fish by constantly throwing your line in different spots. It might seem exciting at first, but eventually, you'll get tired of it and stop trying. And then there's the risk of emotional decision-making. You might make investment decisions based solely on how you feel about a particular stock or company. This is like investing in a hot dog stand on a crowded street corner. You might think it's the best idea, but really, it's just a temporary whim. Now, let's talk about some popular investment platforms and tools. One common platform is Robinhood, which offers commission-free trades for stocks, ETFs, and options. Another platform is Fidelity, which offers a wide range of investment products, including mutual funds and index funds. Another tool that investors use is the stock screeners. These are like magic glasses that help you find undervalued companies based on specific criteria. You can search for stocks by industry, sector, or geographic location to get a list of potential investments. And then there's the world of online communities and forums. These are like online support groups where investors can share their experiences and advice with others who are making similar investment decisions. Now, let's talk about some popular investing books. One classic book is A Random Walk Down Wall Street by Burton G. Malkiel. This book explores the world of investing and provides insights on how to make money in the stock market. Another book that's popular among investors is The Intelligent Investor by Benjamin Graham. This book offers a comprehensive guide to value investing and provides advice on how to build wealth over time. And finally, let's talk about some online resources for learning more about investing. One popular website is Investopedia, which offers a wide range of articles, tutorials, and courses on various investment topics. Another website is The Motley Fool, which offers stock picks, analysis, and advice from experienced investors. Now, let's wrap up our conversation by saying that investing in stocks can be a great way to build wealth over time if done correctly. It's like building a house. You need to start with a solid foundation, plan carefully, and take steps to ensure the house remains safe and secure for years to come. But remember, there are no guarantees in life or the stock market. The key is to be informed, patient, and disciplined, and to always do your own research before making investment decisions. As you consider investing in stocks, keep in mind that it's essential to educate yourself on various investment strategies, risk management techniques, and tax implications. It's also crucial to develop a long-term perspective and not get caught up in the excitement of short-term market fluctuations. In conclusion, investing in stocks is like playing a game of chess. You need to think several moves ahead, consider different factors, and be patient. With the right knowledge, skills, and mindset, anyone can build wealth through the stock market. This is not financial advice. Please do your own research. This information is AI generated. Use it at your own risk.